Welcome, everyone. Welcome to this panel discussion on real asset finance. Today, we're going to talk about recent investment trends and green asset opportunities. I am your host, Swati Roy, for this session. We have a great panel lined up today, and I'm very excited to introduce the panelists. First up, we have Alan Misayaki. Alan is the head of the real estate acquisitions team for Blackstone Group for Asia. Alan has 20 years of experience at Blackstone. He's worked across transactions in the US and in Asia. Welcome, Alan. Next up, we have Daryl Seaton. Daryl is the CFO of Vertus Data Centers. Daryl co-founded Vertus in 2008, and Vertus is now part of the STT Data Centers global platform. Welcome, Daryl. And with me in the studio, we have Jim Cameron, our very own. Jim is the global head of the commercial real estate business for Standard Chartered. And Jim has 20 years of experience working across real estate, infrastructure, and transportation sectors, supporting clients in M&A and strategic finance. So a warm welcome to our panel, Alan, Daryl, and Jim. Thank you very much for joining us today. And we have a great audience lineup. We have 400 plus attendees joining us virtually today. And without further ado, we're going to jump into the panel and the questions. And Alan, maybe if I can kick off the session with you, if you can talk about some of the real estate sectors that Blackstone is focusing on, and specifically if you can emphasize on some of the alternative or non-traditional real estate sectors like logistics, data centers, or self-storage that Blackstone has been focusing on. And the audience would be very keen to understand your views on investment trends and current outlook in these sectors.
Sure. Well, thank you very much for having me. I appreciate it. We're a thematic investor globally. And if you look at the themes that we're really focused on today, there are really four buckets. And the first one, as you mentioned, is logistics. So especially during the COVID period, we saw massive growth in e-commerce globally, and Asia was no exception. Within the logistics sector, we also have what I'd call subsectors. So cold storage, last mile logistics, data centers, self-storage, are also things that we're working on in different countries throughout Asia. In addition to that, we do a lot of multifamily. This is for rent residential, which is pretty common in places like Japan, but really a growing newer industry in places like Australia and some of the bigger cities like Shanghai and China. As we see more millennials getting married later, we see people wanting to stay in urban areas, and housing prices increase and become less affordable. We see for rent residential as a really growing sector to really help tenants out and give them a wonderful place to live in urban environments. The third thing we're focused on is office, which was a traditional office, a very traditional real estate sector, but with the work from home, it's becoming a little non-traditional. But we're still focused on where tenants want to be and where jobs are being created. So we do a lot of data analytics to figure out where companies are hiring. And today, a lot of the companies who are hiring tend to be tech-related, content creation, content distribution, as well as life sciences. So we study where those groups are growing, where they're going to need office, and try to really focus on those markets. And then last but not least, hospitality. And that's in part because as the world's growing and you have a growing middle class, we've always liked hospitality. But I think today, as we work our way out of COVID, I think that hospitality will grow at an even faster pace. I mean, most people around the world the last 18 months haven't been able to do much. And we're starting to see that growth come back as markets open up. The United States has obviously seen a boom in travel. And we're also seeing it in places like the Maldives, which, because of their highly vaccinated population, is open to a lot of international travelers, and whereas other markets aren't. So I think that'll continue to grow as well.
Thanks, Alan. That's very interesting what you mentioned on hospitality. If I can bring Daryl into the conversation. Daryl, with work from home and what we've seen happen in the last 12 to 15 months, there's pretty much been a digital explosion of sorts and a boom in cloud computing. Data centers are in great demand, and Standard Chartered as an institution has seen a lot of investment flows into data centers in the last 18 to 24 months. If you can talk a bit about Vertis, which in a way has been an early mover in this space. So if you can talk about the evolution that you have seen in the data center industry, and what do you think is the current outlook and investment themes that are emerging?
Sure. Thank you, Swati, and hi to everybody. Well, I think as we just heard, the data center landscape's evolving quickly, and it's no longer really the emerging asset class it was when we started over 10 years ago, and even when we raised funds first from Standard Chartered about 5 years ago. So for those of you who are not so familiar with the asset class, although our clients typically would see us as a technology services business, from an investment perspective, as a sector, we've got a lot in common with property infrastructure. For example, I used to describe our business as similar to a self-storage operator, whereby instead of storing sofas, we might store the customer's servers. So on the demand side, when we were launching our first facility in 2011, there was a strong outsourcing element to the demand drivers. The DC, the data center, was a bespoke location to keep client servers rather than using expensive and perhaps inappropriate real estate in the customer offices, which didn't really have the temperature controls or the resilient power or the adequate fire suppression that you might have in a bespoke facility. But as Swati was saying, there's been a massive growth in the last 10 years, not only through COVID, from fueled by all things digital, from Netflix to Amazon to Uber, and the use cases are well documented and largely accepted now. So in the UK, the market demand has recently been transformed by the largest cloud providers, such as AWS or Microsoft Azure or Google Cloud, and I know this picture is common in many geographies. The three main attributes that go some way to explaining the strong investor sentiment and appetite are, firstly, the strong underlying demand for the product, secondly, the recurring revenue model, and thirdly, the sticky customer base and very low customer churn. So over the last 10 years, the facilities we've built have grown hugely. For example, one of the data halls in the last facility we launched is bigger than the entire data center was in 2011 in our first facility. And this brings both opportunity and challenge to operators. The real pressure is to have the right product at the right time in the right place for our customers. That means the check sizes are getting bigger. While the market is still and has always been competitive, the dynamic has changed. There's less new startup, and perhaps competitors are more likely to be established operators entering from another market or customers looking to self-build.
Thanks, Daryl. Thanks for sharing that perspective, and it's great. You're right, Stanchart has been a partner to Vertis Data Centers and to STT, and we've seen that growth and exponential trajectory that the company has seen. So thank you for sharing that insight. If I can ask both Alan and Daryl, and maybe Alan, I'll start with you. If you can talk about the current situation, the pandemic that we're in, and what, in your mind, is the biggest impact of COVID-19 from an investment outlook, investment behavior perspective in the sectors that you're active in, and also overall in terms of deal making and decision making, how has the environment impacted that?
I mean, it's obviously been a very challenging environment for everybody, not only from families and people being affected around the world, but, obviously just the impacts of being in lockdown and what it's done to everybody's, mental psyche as well. So it's been very difficult, but it's interesting in a way. It's really highlighted some of the things that we already believed in or thought, but didn't realize quite to the extent of its impact. So the first I'd say is we call it boots on the ground. So having local teams in local markets. So for our real estate business, we have 7 offices across the region and about 115 people. And we always thought it was important just because, if you have to fly 9 hours to have a coffee with somebody, you're probably not going to be the first call for a deal. Whereas if you're down the street, you probably have a higher chance of having a discussion about a deal. And so that's why we did it initially. And then what we found through COVID, with all the borders shut and nobody being able to travel, that ended up being a big differentiator for us. So all of a sudden, we could go to a seller and tell them that we could transact, we could finance, we could asset manage in these local markets without actually having to have a capital source or a boss from Hong Kong or Singapore fly in and actually see the properties. We could count on our local teams to do that for us. So we were actually able to do more volume and do more business than some of our competitors during this period. And it wasn't, I think we were just better positioned by having teams on the ground. So I think that, like what you're seeing in trends in logistics, like what you're seeing partially in trends in retail, COVID very much so has been an accelerator of some of the things that we're already seeing in the world. But I think that, it meant that my mom, who's well into her 70s and never would buy groceries online, started buying groceries online. So I think that those types of things that were trends that were already happening, we saw them coming, all of a sudden became a little bit faster. And so boots in the ground, which is probably the biggest lesson for us through COVID, we thought it was important. It actually became mission critical.
Thanks, Alan. That is so true. I think we've all realized we've achieved so much working from home, and perhaps some of the business travel that was happening could be avoided. So yes, that's a great observation. Daryl, if I can ask you the same question, I think it's probably a little bit on the other end of the spectrum. We spoke about the growth in data center and the boom through this COVID period, but how do you think that has sort of changed investor behavior through this period, and also in terms of deal making, decision making?
Thank you. And Alan's spot on. The experiences we've been through as a society have, from a business perspective, largely accelerated and exacerbated trends that were already present in our lives. So more screen time, more work at home recently, more cloud-based services, more internet retail, they're all driving customer demand for data centers. So for us, I would describe it as a strong performance, but it's a relative story compared to the wider economy and some sectors, as Alan was mentioning, like hospitality, that have really suffered. As a business, we've had very strong customer collections. We've grown strong demand, and we've been able to marshal the supply of finance to build a product. So actually, it's been a very strong period in the last 2 years. But there have also been significant challenges. So running a business and an operating business in this environment meant that we had to put in place measures to protect customers and staff, but also the construction facilities that our customers wanted even more urgently. It was challenging to bring them online through safe working procedures. And so what I think that what we've seen is the visibility of how critical the digital infrastructure is at a macro level to keeping things going has really come out of COVID. And perhaps, as I touched on before, the emerging asset class that we've become is more recognized. I don't think we're doing anything different, but perhaps more people are aware of what we're doing. And an example of that would be that we were, as a business, particularly the people in the operations team, given key worker status in the UK, so they could go to work during the national lockdown, and involvement in national forums to work out how to get through and how to keep the digital economy going, which we were part of as a company. So I think from an investor perspective, good story prospective data centers is perhaps relative, not absolute. And nothing's really changed for us, and perhaps it's what around us that's changed more.
Thank you. Thanks, Daryl, for that. Jim, if I can bring you into the conversation. So we've heard both from Alan and Daryl that deal making is still possible. Investment flows are still ripe. and there's a lot of interest in most of the real estate sectors. Maybe if you can talk a bit more about the financing perspective and what's happening in the bank market to support some of these real estate sectors, such as logistics, data centers, and so on and so forth. And besides just the traditional bank financing, when you look at alternate forms of capital, whether senior or mezzanine, capital markets, bonds, even the advent of private credit funds that we're seeing in the region, if you can share your perspective on what innovations you're seeing in terms of the capital structure.
Yep, no, very happy to. Thank you, Swati. What we're seeing from a financing perspective really mirrors what Alan and Daryl are seeing and have described from an investment perspective. So, over the last 18 months, we really have seen the acceleration of some of the themes that were already coming through, especially in some of those alternate asset classes. So things that were slightly more peripheral from, say, a real estate perspective. So, logistics, data centers, as Alan described, build to rent, multifamily type facilities. These have all really accelerated in terms of the amount of investment, but also, the last 18 months has really demonstrated the resilience of the investment thesis. So from a finance perspective, the risk reward of supporting these assets has really proved its worth over the last 18 months. So in the same way we've seen a lot of investment appetite into these sectors, we also see a lot of financing appetite going into these sectors as well. So we've seen that through 2020 and accelerating into 2021. So, just some of the examples. There's a large transaction which was publicly announced in 2021, which was, thank Alan for allowing me to mention it first, but the sale of Blackstone's logistics portfolio, Project Milestone, down in Australia, where a multi-billion-dollar transaction, private markets competing against public markets. Really strong demand, really strong bidders, and very strong committed financing across a number of bidders in the last stages. So, very significant financing appetite for those kind of situations. And likewise in the data center space, we've seen sort of exponential increase in the number of opportunities to provide financing. What we've seen from a bank perspective, in addition to just volumes, I think is also development of the terms for some of these assets, and especially some of our clients. What we did see through 2020, which is sort of normal in a time of some increased stress, is there is a flight to quality in the financing markets, and that's from an asset class, but as well as from a borrower perspective. So, for people like Virtus, for people like Blackstone, a real flight of financiers looking to support those businesses and those assets. And for some of the asset classes we've been describing, with an increase in confidence, we've seen a reduction in pricing. We have seen an increase in sort of leverage that's being prepared to be able to put against these kind of assets, and an increase in certain markets of financing for asset classes that wasn't necessarily there before. So things like self-storage, things like build to rent, especially in markets in this part of the world like Australia. I think some of the things we've also seen as the market has developed, as these sectors have developed, is people moving from single asset financings into portfolio financings. And that's given the opportunity for borrowers to allocate a little bit more market risk, a little bit more demand risk across to financiers. And as people like Virtus, like SGT, others have built up portfolios in these asset classes, you've also seen the opportunity for funding via debt capital markets. And so this year has been very active from a debt capital markets perspective. I think the other thing, just on the alternate asset class, that we've seen in terms of development and innovation is just around markets. So if you take data centers, for example, what you've seen historically is a lot of demand in sort of primary tier one markets. However, with data localization drivers and an increase just generally in demand for these assets, we have seen demand for international standard data centers in second tier markets. So, Standard Chartered, this plays right into our sweet spot. So we've been talking to people in this part of the world around assets in Indonesia, in Vietnam, in India, where there is a significant demand for something like digital assets in the data center space. I think in addition to what the banks are doing, I've mentioned the capital markets. I think something interesting that we are seeing is a rise in the institutional debt market. So I think this aligns with what we're seeing in terms of the significant volume of dry powder that's available for the alternate asset class generally. A lot of that going into significant fundraisings on the equity side, but also allocations of that into the credit and into the debt side. The majority of that is still for Western and OECD markets. So the majority is still going into Europe, still going into the US. But it's that capital that's really driving some of the innovation in capital structures that we've seen in those markets, whether it's unitranche, term A, B loan structures, senior mezz, junior structures. And a lot of that has gone into these asset classes that we've been describing today. I think here, sitting in Asia, what we're seeing is that's coming into OECD markets in Asia, so markets like Australia, markets like Japan and Korea. I think something very interesting is we're also starting to see that more into Southeast Asia. And that's also aligning with some of the asset managers within this part of the world in the real asset space, raising some of these debt funds to increase their AUM outside of the equity space. So people like capitalise have got debt funds, again, public, looking at this space. There was an announcement in the last couple of weeks around the Sun Hung Kai, again, raising a couple of $100 million to look at credit in the real estate space. Interestingly, not just OECD, but also Southeast Asia. So, with the increasing dry powder within the institutional space, we think this is going to be an increasing part of the real assets financing market in time to come, and not just in Western OECD markets, but also looking forward to seeing it come and bring some of that innovation into Asia more generally.
Thanks, Jim. Maybe, Alan, if I can just bring you into the conversation. Jim spoke about the Blackstone logistics transaction in Australia. Just to understand your perspective on, on transactions that Blackstone is doing from a capital structure perspective, what are you seeing in the market in terms of, various forms of capital providers and innovations in the financing market?
No, I think Jim is spot on. Obviously, there has been a little bit of a retreat in some of the capital markets. So I think that there has definitely been a flight to quality, so that the better known borrowers are still able to borrow, but maybe some of the first time borrowers or newer entrants in the market are having a little bit tougher time. And if you are able to borrow, we are seeing in general spreads have decreased. We have seen LTVs go up. I think that a lot of the investors, be it a debt fund or be it banks, are willing to be more aggressive, but they're just pickier about the sectors as well as the investors that they're willing to work with. So I think that that's definitely the flight to quality. Going and trying to finance an industrial portfolio these days, you're going to be a very popular person. If you go and try to do a portfolio of shopping centers, you're probably not going to be quite as popular. I think that's just kind of the reality of the market these days, but that's definitely what we're seeing.
Thanks, Alan, for that. If I can just shift gears a bit and talk about sustainability and the green agenda, and maybe Daryl, if I can bring you into the conversation. The growth in data centers is great, but it is also a known fact that data centers now are an increasing consumer of electricity, of global consumption. So how do you think the industry on a whole is sort of rising up to become more sustainable, rising up to this challenge? And specifically for Virtus, how do the ESG initiatives, what are your ESG initiatives for this year and beyond?
Sure. I mean, understandably and rightly so, ESG has been a big part of our internal and key customer discussions over the last few years. So I think data centers are the right place to aggregate computing power, and it's much more efficient than the dispersed alternative, but it doesn't stop there. So we've actually been promoting our green credentials for over a few years now, and our parent company is going public with a portfolio-wide ESG comprehensive document setting out aims and targets in the second half of this year. So we're very connected in that way. We see ESG as in the following way. I think that environmental side of it is really all about conserving the planet's natural resources. So we're talking about the use of power and the use of water. Virtus, we've been procuring 100% renewable power for a number of years now across the Virtus estate. And I recognize that's something we are able to do in the UK, and that's more challenging in other geographies. But also it's about the efficiency and the sustainability of the construction and design of our facilities, and that's been changing over the time we've been operating, each time evolving rather than evolutional rather than revolutional, if you like, to produce class-leading efficiency in the power consumption of what we deploy compared to what we deployed 10 years ago. I think ESG's focus is often about power and energy, but there is also an S and a G in it. From the social perspective, we talk a lot and we act increasingly across the business, but across our partners and suppliers as well, to create a safe and secure and inclusive workplace for everybody. That covers not only our workplace but our construction sites, and there's been a huge focus and effort to raise the bar and promote best-in-class activities across all of our sites and demonstrate that to our customers, who are increasingly focused on and interested in that, as you would expect. And then on the G, on the governance, I think that ethical and responsible operations in our business and how we act and how we behave with integrity and how we contribute to the economic and social activities of the surrounding areas that are operated and the communities that our facilities have operations in. So, for example, we were supportive of a local charity food bank in Enfield, and we might sponsor a community football team in West London. So I think it's wider than just power. Often the focus is on power, but there's more to it from a Virtus perspective.
Thanks, Daryl, for sharing those initiatives. Maybe, Alan, if I can ask you a similar question around Blackstone's ESG initiatives, but more importantly, how do you see that interacting with your investment philosophy in some of the sectors we just spoke about?
Oh, it's a great question, and I think I really agree with a lot of things that Daryl focused on here. The reality is it's an important part of every transaction. So when you look at one of our investment committee memos and how we look at any transaction, there's an assessment that we do. We used to just, if you went back, 15 years ago, you had a phase one environmental report, you had a, engineering report. This is also something that was a factor in how we look at every deal. So it's not just, what's there, it's how can we improve it? If it's a new build, how can we build it in a more efficient manner? Everything from, what Daryl was talking about, power, how we can be environmentally friendly. And I think it's not just, you're doing it because it's the right thing to do, but it's also from a, competition perspective also important. Here in Australia, you can access more tenants. More government agencies will go into your building if you have certain ratings. So I think that, you have to not only do it for to be competitive in the local markets, but it's where everything's going. So I think that's, on the power, the sustainability side. But I think that, Daryl was hitting on some very good points here. That's important. And that seems to be where there's a lot of focus. I mean, we've at Blackstone committed to reducing anything we buy to decrease their carbon footprint by 15% during the first 3 years of ownership. So that's obviously a big focus for us. But I think some things that Daryl was focused on also in terms of the governance and the other parts of ESG that probably don't get as much airtime, but are also extremely important. So it's everything from your other stakeholders, so unions, your employees, how your company or how your portfolio works in the community. Those are also extremely valuable. Now, if you go back in India, we have a 100 megawatt solar farm, and we actually built it before anybody was really talking about ESG. We built it because we thought it was actually a really good business. It was we liked the solar, we liked the infrastructure to help support our office parks, and we did it anyway. And it's just good business, and it's continued to be great business force there. So I think that all these different aspects are extremely important, and they come into consideration in every deal we do.
Thanks, Alan. That's a very relevant point. ESG and sustainability is important, not just from a social perspective, or that's the right thing to do, but also from a competition, and it makes investment sense. So totally agree with you on that. Jim, if I can bring you in at this point, Standard Chartered as an institution has announced Chapter 3 of its transformation, and one of the bold stands we've taken is accelerating zero and getting to net emissions of zero by 2050. Can you talk about what initiatives Standard Chartered has taken in the bank financing space and in the real estate green financing space?
Absolutely. Look, I'm very happy to, and I think, first of all, it's great to be part of an institution that has such an authentic focus and is dedicating a lot of resources to this. And that's not just, it's the right thing to do, but I think importantly for the reasons that Daryl and Alan pointed out, it's actually very high up on our clients' agendas, and it's very high up in terms of the value that we can give to clients and the value that we can create for clients and help clients create. So we do see this as a very key topic for us to be taking up in the real assets, in the real estate space. In some of the analysis that we've looked at, why it's relevant in the real estate space, the real estate space, if you include scope 1 to 3 emissions, is responsible for around 15% of global emissions, which means that on the one hand, there's a lot here that can be done. On the other hand, it does mean that for governments, for tenants, for investors, this becomes a very large area of focus. So we are seeing legislation come into different countries. I think there's around 73 countries globally that either have mandatory or voluntary standards around buildings. We are seeing tenants increasingly looking at the carbon footprint of their real estate, and therefore it's being taken into account in terms of some of those location decisions. And we're seeing that in a post-COVID world where building profiles, energy efficiency, wellness factors, flexibility of layout are all very important in terms of consideration. So that's going to Alan's point around competition here. And then we are seeing it in investors. So mandatory disclosure from an investor perspective means that low carbon, ESG related investments are particularly important. So we are seeing it as a key competitive opportunity. What we're doing at Standard Chartered, we're working with clients at various different levels. We're working on a transactional level, talking to clients around how they can structure and mobilize sustainable financing into particular situations, and very pleased to have worked with Daryl on a number of the transactions, recent financing transactions that have been put together in a green format in the UK recently. We are talking also to clients, on a portfolio, a corporate or a fund level, both to allow them to understand, what the importance of ESG is, how and why they can improve their communication and their management of ESG factors, and why it's important in terms of mobilizing capital, or whether that's equity or debt, and talking to investors. Within the real estate space, we've got some exciting initiatives working with some of the rating agencies. So the great thing about the real estate space is your assets are quite discrete, and some of the standards around ESG, especially around green buildings, are relatively well known, relatively transparent and measurable. So the allocation of sustainability aligned finance into those assets and situations is straightforward compared to some other asset classes. One of the areas that we've been working on is with the IFC, who have a ratings product called Edge, which is a relative as well as an absolute benchmark. So that's exciting for us because it means that can be used within emerging markets, possibly more than some of the the other standard BREEAM lead rating approaches. So it's exciting for us with our EM footprint. I think some of the other areas where it gets interesting is when we start putting together some of the different areas of our real assets business. And that's where we combine some of our commercial real estate clients with some of our renewable energy clean tech clients. So how can people with large footprints, whether it's in the data center space or elsewhere, really replicate what Darryl was describing with STT, and that's sourcing renewable energy to be able to allow that energy intensive real estate development to continue. So a big focus on that around data centers, but also just a big focus around that with some of our big real estate clients. So either putting together sort of dedicated facilities on site, so things like rooftop solar into industrial or logistics facilities, which tend to benefit from large roof areas, looking at energy efficiency schemes, or looking at renewable energy plants elsewhere, providing captive energy into some of these assets, or some of the areas that have been very interesting, and where we think we're able to add some real value with clients.
Thank you. Thanks, Jim, for that. We actually have a couple of questions coming in from the audience, and this one, perhaps, Alan, if I can direct to you. There's a question around alternative forms of financing, such as Term Loan B in APAC, and if there is any jurisdictional bias for such forms of financing.
I'd say today we're probably, those have obviously grown. We probably see it a little more in the private equity space than we see in the real estate space to date. If you look at some of our core plus products in other parts of the world, we've definitely seen more corporate financings for those. But I'd say in APAC to date, it's probably still, at least for us, mostly a mortgage market.
Jim, would you agree with Alan in that view? I mean, do you see term loan Bs making a presence felt in Asia?
Not to a material extent today, but I do see it mentioned earlier as part of the development of the market here. So we are seeing more institutional capital looking at markets in different countries in Asia Pacific. As I mentioned earlier, we're seeing it more in some of the more developed OECD style markets. Some of that financing, as 10 years ago, we're seeing much less of that. 5 years ago, much less of that in the private equity space. What it does show me is that private capital is being looked to be put to work in this part of the world more, and something like real estate is a very natural home for that kind of structure. So I don't think it'll be long before we see some of that technology being exported from markets like the US into Asia Pacific more generally.
Thanks, Tim. Thanks, Jim. Thanks for sharing your views on that. Darryl, there's a question for you in terms of do you see export credit agencies supporting potential financing in data centers?
In what context? Can you expand the question a little bit? And I know it's not yours, Swati.
Mm-hmm. Yeah. No, I think the question is more around, do you see ECAs or multilateral agencies supporting financing in data centers? I mean, Jim, maybe you can step in here as well. I think from a Asian context, we have largely seen traditional bank financing in this space, but it would be interesting to hear your views if you think ECAs and multilaterals would also step into this arena.
Darryl, maybe I'll kick off and then sort of feel free to add in, because maybe in a UK context we may see less of the ECA financing. So I think generally we see, as Swati said, sort of bank financing uncovered, so without ECA cover. Especially as from a data center perspective, the majority of the spend is on the shell, on the HVAC systems, rather than on the equipment that goes in, which would be more of the imported equipment, which would be more eligible for ECA financing. I think that also reflects that most of the financing to date has been in those first tier markets. I think what we are seeing, and we have had as an institution some interesting conversations with some of the MDBs around their interest in financing these assets directly, not necessarily with ECA cover. We may see some guarantees from people like the ADB, but I think we'll also see some direct lending coming in from the other MDBs. Where I think that's going to come in and be very interesting is around some of these second tier markets that I was talking about earlier, where you have demand for international data centers. You do have some of the hyperscalers looking to provide reasonable offtakes in these or usage agreements, contractual agreements within these assets. And so in those kind of situations, you might see sort of first loss or longer tenor or some kind of risk mitigation coming in from the MDBs or the ECAs. So I think that can be an important or an interesting part of that financing for the second tier markets.
Thank you, Jim. I understand what the question was now. It's not something we see much of in the UK market. I think when you look at the span and the spectrum and effectively the pricing and the maturity of the business, the direction of travel thus far in our business has been from maybe higher price mezzanine debt and investment banking to retail banking and increasingly towards the credit markets. I think that evolution and maturity that Jim was describing in a first tier market perhaps is not so necessary, perhaps it's not so visible, but it's not something we've come across particularly.
Thank you. Thanks, Daryl, for that. There are no more questions from the audience. We're almost at time. Just one last question from me for the panel, and maybe Alan, I'll direct this question to you. Just overall, I know you spoke about the investment outlook and the investment trends, et cetera, but generally going into the rest of 2021 and 2022, what's your view on valuations? General view in the market is there is a lot of liquidity chasing few assets, and bank liquidity is in abundance. So how do you see valuations moving from now to next year?
It's interesting. We tend to look at things from a global perspective, and where you've seen values move in parts of Europe as well as the US have actually moved a lot further than we've seen in Asia. So I think on a relative basis, Asia is actually more attractively priced than we've seen in some other places. I think that that's in part because some of those economies are a little further in terms of coming out of COVID at this point in time and reopening. So a lot of that's been priced in, but I think there are still some really attractive opportunities to be had in Asia. And I think especially in sectors that are a little more complicated. So in the, larger corporate transactions where, maybe they're a little more complicated, a little more misunderstood, there is still pretty attractive value.
Thanks, Alan, for that. So on that positive note, valuations are attractive. There is a lot of activity in the real estate sector, specifically in the non-traditional and alternative asset classes. So that's great news for all of us. With that, we're almost on time. I'd like to thank our panelists, Alan, Daryl, and Jim, for joining us today. Thank you so much for this engaging discussion. And thank you for your time. And thanks for the audience members for being with us today. Thank you so much. Stay safe and take care.